People are saying that President Trump is about to change your 401k forever. The only question is, will this executive order make things better for the average person, or is it a deceptive way to bail out private equity and elite institutions while you and I fit the bill? Good afternoon. You are watching Filibusted live, and I am in need of a haircut. I want to start by saying nothing in this video is financial advice. This is for educational purposes only. Please do not make financial decisions based off of what I'm saying. I'm not a financial expert. I'm just a guy hanging out in my in-laws' basement. So President Trump is reportedly looking at signing an executive order very soon that will change who can invest in private equity. If you're not familiar with private equity, I will be explaining that in just a moment. But at the moment, all you need to know is that private equity funds are exclusive investment opportunities for super wealthy individuals and elite institutions. So the order that Trump is looking at signing into effect, what it will do is going to open up these funds to average Americans to be able to invest in, no longer just exclusive individuals. So this will be done by allowing 401k managers to invest in private equity. So in the near future, your 401k could be heavily invested in private equity assets that previously could only be accessed by the super wealthy. So people in favor of this move are calling it the, quote, democratization of the market. And the reason they're calling that is because basically about 1/5 of the investment market right now is in private assets and cannot be accessed by the average individual by going on the stock market or stock exchange, and purchasing stocks and that sort of thing. And in fact, I've seen from many articles, there's actually been a growing fear in recent years that basically the private equity industry has been eating up the public investment opportunities. And as private equity has grown, it's gotten more and more popular among super wealthy investors and wealthy institutions. What it's done is it's basically been buying up a bunch of private companies, buying up public companies that used to be publicly traded, making them private. So that means that the sphere of the public investments has gotten smaller. And so that's what some people are saying in favor of this executive order. They're like, this is great. It's going to reopen up these private assets to the average Joe to be able to invest in them through their 401k, right? So that's what the executive order is supposedly going to address. Now, everybody who has a 401k can see their money go into these private equity assets. One potential downside before I get into the massive controversy around this, because you think this sounds good, there's actually a huge controversy around this, and some people think it's horrifically bad. But before I get into the huge controversy, one should be well-known fact about these. Although the money that goes into these private equity funds are supposedly supposed to be expertly managed in order to make a high return on investment, there are really high fees associated with them. So private equity shoots for trying to get 20 to 30% returns on investment from things that I saw, which is crazy high returns. That's like their goal. They're trying to get 20 to 30%. However, in order to do that, they do charge really high fees that can end up eating up a lot of that, your return right there. So that's just kind of a general sort of investment advice that goes into, potentially investing in private equity. But that's not the controversy. Let's get into the controversy here. So, this sounds good. More investment choices for 401k holders. What could go wrong? Well, there's a lot of people sounding the alarm bells on this right now, including this lady here on TikTok, on X. And you'll see some more as well. But it's because it's not just the high fees that's associated with that they're concerned about. It's actually like a big scheme, essentially, that's kind of secretive and being hidden from the public, trying to take advantage of the gullible public who's going to get in on this investment opportunity, right? So let me paint the narrative for you. This is the narrative, and then we'll get into how likely it is to be actually true and really going on. But here's the scenario that's being painted. This lady, as well as many others I've seen, are painting a picture that President Trump is doing this because private equity and their investors, the wealthy individuals and wealthy institutions that are highly invested in private equity, are in a pickle right now. And the claim is that the private equity industry has been doing such a bad job of managing their funds that right now all their holdings are basically toxic assets that they need to get rid of. They want to get rid of these assets because they're going to go belly up. And so the wealthy individuals institutions, Yale and Harvard are a couple of these large universities. Their endowments are usually stuck into private equity. So they have a bunch of money invested in private equity, and they can't sell off their assets without losing money. So the play that we're seeing here is they're going to open up private equity to 401k holders, and then they're going to sell off the private equity assets to these new gullible, naive buyers, the 401k holders, the 401k managers, who think they're getting in on something exclusive that's going to make them a lot of money. But in the end, it's actually going to be a rug pull, and they're going to lose a bunch of money. So yeah, so the potential here is that it's just a way for the private equity industry to save their own skin by pawning off their losses onto you and I and the average 401k holder. And it's also a way for the super wealthy and elite institutions like Harvard and Yale to get out of these bad assets and to save their endowments from going under. And so if I scroll down a little bit, you can see some of what this lady is claiming here. So she's calling this basically, this executive order, a quote bailout for the private equity industry, right? And to be clear, it's not a bailout in any sense of the word. It's not the government giving money to these firms to bail them out. But if what she's saying is true, if this narrative is true, then essentially it's just a way for them to sell off bad assets, make their money, and then leave, the average Joe 401k holder with the loss. So it's a really fascinating theory here. I'll just read off the numbers she's throwing out here. She says private equity is collapsing $3 trillion in over-leveraged unsellable assets, 14 to 21% interest from floating rate debt. Harvard and Yale can't unload $8 billion in private equity stakes. No institutional buyers left. Their solution: take your retirement. So she's saying that the industry is in a bad state, and they're going to try to pawn off these toxic assets again to the 401k holders. And this executive order is going to allow them to do so. So fascinating theory, very interesting. How bad is it? Is it really actually as bad as she's saying and a few people are saying as far as the private equity situation is going on? Well, let's take a look at maybe a slightly more even of the road approach to this scenario. So this is an article by The Hill. And The Hill starts out by pointing out some of the potential upsides to this expanding the private equity into the 401k, buyers essentially. And so a couple of the upsides they talk about is, there could be better gains than normal funds for these 401k holders. Like I said before, 20 to 30%, that is nothing to sneeze at. And that's some of the historical rates that private equity funds have been able to get. There's a reason why they exist. There's a reason why the wealthy like to invest in them. It's because if you can get a 20 to 30% return on investment, that's tremendous, right? So they bring up that point, and they bring up, of course, there's more options. Usually more options to invest is a good thing. If you're opening up, to the average person, be like, hey, you can invest over here now. You weren't able to before. That's more options is a good thing. Even if the funds are riskier, there is a chance for higher returns. Riskier funds, but chance for higher returns might be worth it. However, this article also points out the timing. You can see right here, access to 401ks couldn't come at a quote better time for private equity. So what is the timing about this that makes this executive order, that makes this so suspicious? It makes it suspicious for a lot of people. Well, if I scroll down here and get into the assets managed. Here we go. Assets managed. So here's the timing that we're looking at. This is the state of the union per se for the private equity market right now, and the timing of why this is so suspicious. So right here, they say assets managed by buyout firms. I'll get in that in a moment, but they're talking about private equity firms. So these private equity firms, their assets that they manage shrunk by 2% from 2023 to 2024 to mark the first contraction in the sector in decades. The Financial Times reported earlier this year, citing research from consulting firm Bann & Company. So in the last couple of years, the assets have actually been shrinking that these firms are managing, right? It also says capital investment in the industry lagged throughout 2024, the firm's research found. There are also numerous reports that private equity has taken in much more money than it has paid out in recent years, as much as $1.6 trillion. So there's evidence that this private equity firms are taking in a lot more money than they're actually making and paying out right now, paying out to their investors. And it's leading to concerns that the sector is fundamentally overvalued. So that's the concern here, is that like that lady mentioned, that there's could be a pop about to occur. Essentially, this market, this sector is overvalued, and it's going to pop because it's not actually worth as much as they claim to be worth at this moment. Last paragraph here: by opening up private investments to retirement funds, the fear is that the institutional investors and rich people will be able to exit the overvalued market, just as less savvy investors are encouraged to move into it. So that is the concern. How bad is it really going to be? I don't know. I have no idea. But there is legitimate concern that something like this truly is happening, that they're opening up this to average investors who are going to move in and be like, oh, cool, I've never been able to invest in private equity before. Look at the historic returns, but they're investing at the worst possible time. They're moving in as the heavy investors are actually trying to figure out a way to get out, because they're seeing now this thing is souring. This thing is going under. There's actually a lot of red flags occurring for private equity, right? And so, yeah, an optimist might say, well, if we open up the industry to more investment via our 401ks, then maybe the industry will start doing better. Maybe it'll have a turnaround, right? And everyone will make more money, right? So this could be a win-win scenario. Private equity managers make money off of fees. The wealthy institutions will make money, and us as average Joes, as we put our money into it and the industry turns around, we make money too, right? But a pessimist, of course, would say, what if the industry doesn't start doing better? What if this is the beginning signs of it, plummeting essentially? So we'll get into that some more. And if we invest our 401ks right now into these private equity funds and all the investments go under, this would be an exceptionally sneaky way, essentially, for some people to get out of bad investments by selling them off to 401k managers, right? So before I talk any more about this executive order and how concerned you should be about this, because is this actually a concern? Should you really be concerned about this when it comes to your investments in your 401k? I want to talk about what is private equity, right? And explain the things that the industry has been doing recently that I believe has led to these numbers that we're looking at here, and the massive concern people have, and why people are so suspicious of private equity. And it really just has to do with how they manage things and how they've behaved in recent decades. So here's a list of some of the largest private equity firms in the world, many of these here in the United States. So I'm just going to pull this up as I explain in a hypothetical scenario how private equity works. Like what is it? What does it actually do? How does it actually work? Okay. So in our little role play here, imagine you are a super wealthy individual. Okay. You have tons of money and you're looking for somewhere to invest your money, right? And I'm going to come in and I'm going to be private equity firm manager, right? So you have lots of money. You could invest your money in publicly traded stock market, like most people do, but everyone has access to the publicly traded stock market. That's boring. That's why it's called public, right? Everyone has access to it. So you want a more exclusive investment, something that only super wealthy people can get in on, or wealthy institutions like we talked about. Harvard and Yale also are invested in private equity. But of course, mainly what you really want is a way to invest that ends up giving you a massive rate of return, right? You're looking for that 20%, 30% rate of return, and don't want to settle for like a measly 12 to 15%, right? So this is where private equity firm comes in. So I'm going to be the head of Reese's private equity firm. So I come in and I say, hey, rich person, I know several other rich people just like you. You guys all want to find some way to invest your money that makes a big return and something that's exclusive that normal people can't get in on. So why don't you all pool your money together, give it to me, and I will manage it in a fund, right? So that is what we're doing. So in return, I'm going to take management fees of this fund, and you're going to get the benefit of I'm going to use this fund to make even more money, right? I'm going to take all your money pulled together. I'm going to make more money for you guys, give you back more money than you gave me, and I'm going to take some fees out, to pay myself. And so it's a win-win scenario, right? I'm managing your money. And that's what private equity firms are. They're just managing the money of super wealthy individuals in these, privately held funds. So firm owns the funds, right? So how does this work? So if I have a fund, so I'm a firm, right? So now I have a huge fund of money that you and your wealthy friends all gave me. So I got a big pile of cash here. So what am I going to do with the money? Well, as a private equity firm, I'm going to do one of two things. So the first thing I'm going to do is I'm going to buy an established private company. So my example here is going to be Hobby Lobby. If you've ever shopped at Hobby Lobby, Hobby Lobby is privately owned. You cannot buy stock in Hobby Lobby. It's not traded on the stock market. It's owned by a family. It's owned by the Green family. It's privately owned. So I'm going to come along and I'm going to purchase the entire company, all of Hobby Lobby, as a investment firm here. I'm going to buy the whole company. It's still going to be privately owned. It's not. I'm not taking it public. I'm still private. It's privately owned, but now it's owned by my fund, my firm, instead of being owned by the Green family, right? So that's the first thing I can do: buy a private company, keep it private. The other thing I'm going to do is probably I'm going to buy public companies, and then I'm going to make them private. So Walmart is a publicly owned company. You can buy stock in Walmart today if you wanted to. It's traded on the stock market. It's a publicly owned company. So what I would do is I'd take my fund's money and I would buy out all of Walmart, right? And then I would take Walmart as the new manager of Walmart and I would make Walmart private. I would take it off the stock market. And so that's what they end up doing. So now it's entirely owned and managed by my fund, right? So my firm now owns Walmart and Hobby Lobby. What do I do with the companies, right? So remember, I need to make a massive return on investment for the rich people who contributed to the fund. And I basically have two paths in front of me that I can take of how am I going to make a bunch of money with these companies that I just bought, Hobby Lobby and Walmart, right? So the first one is what I would call like the slow, noble path, which is I can manage these companies really well so that they become super profitable and the company grows in value over time, right? That's the slow, noble path. It's a win-win for everybody. The company becomes better and the company grows in value. So I make money from it. My investors made money from it. Everybody wins. Or I can take the other path, which I would call the quick, sleazy path. And the quick, sleazy path is I have a lot of options available to me to try to turn a quick profit, even if it ends up sinking the company that I just bought. So I can start by breaking up the company and selling off its assets to try to make that quick profit, right? Which will eventually kill the company. Or I can do a quick overhaul of the company, change the leadership, rebrand, do a bunch of things that will end up giving it like a higher evaluation very quickly on the market. People will be like, oh, this company is now worth more. It's doing things. However, if I don't care about what I'm doing, I can actually quickly set up the company to eventually fail. But I don't care about that because, again, my goal is to make a quick profit. So what I'm going to do is I'm just going to sell it off to somebody as quick as I can. I'm going to wait for the evaluation to go up. I'm going to sell it to some sucker who's going to end up being stuck with the bag. And even if the company goes bankrupt in the next 10 years, it doesn't matter. I made my money off of it as a fund manager, and I'm moving on to the next deal, right? So here's our actual real world. So enough with the hypotheticals, right? Let's talk about the real world and some things that private equity has actually done. So real world example here. So my wife likes to crochet. Crochet is kind of like knitting, making things by hand. And she crocheted me this adorable little duck here. His name is Maverick, and he keeps me company while I'm working. So he sits right over here on my desk. Where did she buy the materials to make this duck? So she used to buy all of her materials from a place called Joann Fabrics, which had like 800 locations, and they've been in business for 80 years. And they just went out of business earlier this year, right? So they went out of business earlier this year. They're selling off everything. They are closing their 800 stores, and they're laying off 19,000 employees. So everything about this is terrible, right? They were a great store. They sold supplies that were otherwise pretty hard to find for people that liked arts and crafts. And now a lot of people are losing their jobs. That is all just gone. So a lot of people are actually blaming private equity for this. I forgot to pull up my article here, but you can see it's titled right here. Did private equity kill Joann Fabrics? Maybe not, but experts say, its fingerprints are at the crime scene. So let's talk about this. Because a lot of people are blaming private equity not only for Joann's failure, but also for many businesses that have gone out of business or declared bankruptcy. in the last few years, especially the last decade. So they were a private company, and they were they were not a private company. They were a publicly traded company, but they were bought by private equity back in 2011 for 1.6 billion dollars. Okay, so a 1.6 billion dollar bill bought by private equity, and the firm that acquired them used what's called a leveraged buyout to acquire them. So this is really important because this is par for the course for what private equity does. So leveraged buyouts is where a firm takes out a massive loan to buy the company. So with these deals, the firms oftentimes only put up 30% of the actual money. So from their fund that they're managing, they'll only actually put up 30%, 20 to 30% of what's needed to buy out the entire company. So that's only 20 to 30% of that $1.6 billion to buy out Jo-Ann Fabrics. And the rest of it, the 70 to 80% of the rest of the money, they just borrow, just a massive loan, right? And they're able to do this because they're purchasing what's considered to be really stable companies. So people will offer them these massive loans because they're like, well, you're buying Jo-Ann Fabrics. Jo-Ann Fabrics has been in business for 80 years. It's not going to go out of business. So they give them this massive loan to allow them to purchase this company, right? So they purchased the company. They purchased Jo-Ann Fabrics. They made some changes to the company. I don't know all the changes that they made, but I do know that in general, these private equity restructures can be really ruthless and brutal in terms of like layoffs and breaking up the company and the different ways that they rearrange things very quickly. And this is all based on the fact that the fund has to find a way to make money really quickly on its investment, especially if they did a leveraged buyout, because the leveraged buyout, which is extremely common for private equity to do, it makes the deal way riskier because now they have a massive debt that's involved, right? That has to be paid off. And so it's really risky. And so they have to find some way to turn it around and make money for them, right? So Jo-Ann, that was 2011. So not more than too much longer than like less than 15 years later. Now Jo-Ann is closing. It's closing. It's shutting down. It's gone, right? And to be fair, there does seem to be other factors at play here besides just private equity, but there is a pattern here with private equity getting involved with companies and then those companies going bankrupt within 10 years. So this is actually mainly because of the leverage buyout thing that I just talked about. So some research people have done shows that leverage buyouts greatly increase the chance of a company going bankrupt. In fact, 20% of large companies that are acquired with a leverage buyout go bankrupt within 10 years. And so you just saw that with Jo-Ann Fabric. They were purchased with a leverage buyout, and within 15 years, they're bankrupt, right? And so, and the reason this happens is because that deal ends up saddling the business with an enormous amount of debt. Remember, 70 to 80% of the buyout comes from borrowed money, and that debt doesn't just go away, right? And so it ends up saddling the business with a massive amount of debt, and that makes it really hard to operate as a company when you have that much debt. And even if the private equity firm sells it off to somebody else and they end up inheriting that debt, they have to do something with that. So the leverage buyout, like I said before, this is the norm for private equity. It's actually kind of the thing they're most known for is these leverage buyouts. And the industry is known for this. In fact, these private equity firms, they used to be called leveraged buyout firms. That's how much they're known for the leveraged buyout. That used to be their name, but they rebranded in the 90s. So the Hill article I brought up earlier, it talks about how they were the reason they rebranded was because they were racking up massive business failures and they were facing a lot of media scrutiny. And so in the 90s, they had made such a bad name for themselves that they decided their best course of action was to, rebrand themselves and change their name to private equity firms instead of leverage buyout firms, right? To try to get some heat off their back because they just made such a bad name for themselves. But just because they changed their name doesn't mean that they're still not doing that kind of same sort of sketchy stuff. So as a result of these kinds of buyouts and the way that they, try to turn quick profits, like I talked about, research has shown private equity is responsible for directly or indirectly 1.3 million jobs being lost from the 2010 to 2020, right? So over that decade, you have over 1 million jobs being lost. Research pointing directly to private equity being responsible for that, doing the same kind of thing that they did with Joann Fabrics. And the worst part about this, and the reason I'm harping right now on private equity, is because there's a misalignment of incentives. Usually, if something is going poorly and it goes poorly long enough, then there will be some sort of correction and people will correct things. But there's a bit of a misalignment of incentives, which is why this hasn't been corrected yet. And that the reason is because these private equity firms, they can still make money even if the businesses they buy end up failing, right? So as long as the private equity firms find a way to make money, they don't have any incentive to stop doing this kind of thing. So I said earlier, they make money off of fees, right? But they also have a host of sleazy ways that they can try to like pump and dump and make quick profits with the businesses they buy, even if they end up, those same businesses end up going under, later on, going bankrupt later on. And so you have firm managers that they're making money no matter what. They make money even if in the long run they're losing their clients' money, the wealthy people that gave them their money to look after. Even if they end up, their funds over time go down, the people who are managing the funds, they're still raking in the fees, right? They're still making money. So even if they kill the businesses that they're buying, if they hurt the economy, if they make 1 million people lose their jobs over 10 years, these firms are still making money. And so that's the concern. That's my main concern here when it comes to the private equity stuff. I could have started this out by talking about the fact that like I'm not just digging on rich people or taking cheap shots at wealthy individuals. I'm not some eat the rich kind of person. I'm definitely like a capitalist through and through. But I am a fan of managing your businesses in a way that's good for everybody, not in a way that's only good for you, as everybody else ends up footing the bill for you essentially when you take the money and run, right? And then everybody else has to foot the losses. I'm not in favor of that, and I'm definitely not in favor of manipulating the government in order to make it to where if the losses are going to come back home and you're going to have to pay for the losses at some point, whether you're a wealthy individual that invested poorly or had a bad management group invest your money for you, right? You as the individual, you should pay for that, right? Or the management firm should pay for that. We should not get the government involved in a way that's going to spread the losses, as they say. Capitalism is not socialized losses, right? It should never be socialized losses. That's not true capitalism. And so I just want to make sure that that's not something that we're doing here. And so, right. So this is a concern. I do have a list, as I talked about. These firm managers are making money no matter what, even if the things they're doing is bad for the economy, bad for businesses, even if it loses the funds money over time. I just pulled up a random list here of billionaires that have made their money by managing these firms. So this is a massive industry. There's people that are making a lot of money off of this, even if the things that they're doing is actually hurting the economy, right? And so that's pretty much the summary for why are so many people concerned about the 401k executive order. It's basically the question of, do we want our 401ks invested into this kind of industry, right? Where they take our fees, they run companies into the ground, don't really have a long-term concern for business or the economy, and they ultimately lose our retirement accounts in some investment risky bets that they don't really care because they're taking their fees, and they're moving on and they're still, coming out well in the end. So back to this executive order, right? How concerned should we be about our 401ks, right? So if you have a 401k, I do have good news. I know this all probably sounds like bad news right now. And I think the private equity, industry is really fascinating and something I wanted to talk about for a long time. And unfortunately, there's a lot of bad to it, and there's been a lot of bad management. And I think in general, the philosophy behind it that most of the firms run off of, with the like turn as quick as the profit as possible, even if it hurts the economy, even if it hurts the businesses, even if it runs all these businesses into the ground and people lose their jobs. I think the philosophy behind it is really terrible, really, really, really corrupt. And I hope that can change somehow. I'm not exactly sure how to change it, but bringing attention to the issue. But I do want to talk about individuals and their 401ks. So the good news is, like we said, if this executive order goes through, what it's going to do is it's going to open up the 401k managers. So now they have the ability to invest your 401ks into private equity. They can start buying these private equity assets, right? Now, there's risk there, obviously, but here's the good news. In general, 401ks are what you invest in is somewhat optional in general. So this is probably not going to be forced on you. And here's why. So whenever you have a 401k, you are limited in your choices, but you usually have like several bundles that you can choose from. You'd be like, all right, my 401k is going into, they might give you like 3 or 4 bundles. They're like, well, I'm going to go into that bundle, but I'm not going into that bundle, So usually you have some limited choices with your 401k. And so I'm just pointing this out to people because if this executive order goes through and the private equity industry gets opened up to 401k managers, some managers might be concerned and might be like, oh, this looks risky. I'm not going to invest heavily in this. But other 401k managers might jump on the opportunity and say, oh, this whole industry just got opened up to us. We're going to pour a bunch of money in here, And so if you take a look at the options that are available to you in your 401k, do a little bit of research on them, I bet you will be able to find out pretty quickly whether or not they are leaning towards investing into private equity or not, right? Usually between those options, they break it out for you and be like 50% goes into stocks, 50% goes into bonds. I have reason to believe this is going to be a similar scenario, that it should end up being at least somewhat transparent so that you can see, oh, what's this smaller percentage going to? And then if you look into it, you'll see, oh, it's going into private equity, right? So if you are so concerned and you don't want any of your investments going into private equity, just choose the bundle that doesn't have the private equity option on it, right? Or if private equity does end up actually getting into almost all of the bundles, again, usually they're rated by percentages. So just choose the option that has the smallest amount of private equity investment, and most of it's still in stocks or most of it's still in bonds, that kind of thing. And so just letting you know, I'm not trying to tell you what you should do with your 401k. I'm not a financial advisor, but you absolutely can look at your bundles and see what's in them. And if this executive order goes through, then there's definitely going to be some information out there about what are the 401k managers doing? Are they actually heavily investing in the private equity or not? Or do they think it's too dangerous, right? And so that's one option, right? You should have some control over this. If you pay attention to your 401k, there should be some amount of control that you decide where you want that money to go to. So I've harped on that long enough. So here's some potential good news about this, though, that I think is quite interesting. Although there's always risks involved, I still think this is quite interesting. Potentially a really good thing. So this executive order, not only does it open up 401ks to the private equity market or industry, private equity sector, I think is what it's called. It also opens it up to the cryptocurrency sector. So digital currencies can usually be a very confusing field of investment. I know they're confusing to me. I currently don't own any cryptocurrencies, but I'm interested in them, and I know there's a lot of potential there. So this would allow for those who are not well versed in cryptocurrency to have a safer way to invest in cryptocurrency. Because again, with your 401k, everything's bundled together. So you could pick an option that's like, ooh, 10% goes to the cryptocurrency market. I'm going to pick that option because you've done your research and you looked into what's in there and you think that it's going to grow, and that might be a good option for you. So I think this is really interesting. I think there's a lot of potential. So on this channel, we've talked about the potential growth of cryptocurrencies. Doug on this channel is a huge cryptocurrency nerd. And he talks a lot about it. And I feel like we just did one on Ripple, or I forgot their product. We have one coming out pretty soon on a cryptocurrency that a lot of people are talking about right now. So definitely interesting, very cool. Could be a profitable thing for a lot of people. This could be a great option for our 401ks, right? So that's an upside. But another upside, back to private equity. So one more, upside to this is the fact, like I said before, high risk, potential for high reward. What this executive order is doing, many would say, is it's giving the public retail sector an opportunity to dip their hands into what has historically been only reserved for the wealthy, right? So private equity historically has generated better yields than typical investments. Some of those private equity funds have gotten like 20 to 30% yields, as I talked about before. Now, the only concern here is that the timing of this, as we're looking at, there's a chance they could be they could be passing off and dumping bad assets, right, to these 401k managers. And like I said, this is a legitimate concern. So just as an example here, like I said, private equities, they're not doing so good right now. So this might not be the time to get into it. It could be less of a bailout and it could be more of a rug pull, right? And so you've heard about the rug pull tactic that's used in crypto, since I've got crypto on the screen here, because there's a risk in everything. So a rug pull tactic is when you have, for crypto, I've seen this several times, some small time crypto maker makes a new kind of cryptocurrency, and then they somehow get a bunch of hype around it, right? And then it rises in the market and it goes sky high, and they sell off a bunch of it. And then the crypto makers themselves, they get out, they sell all the assets that they had in it. And then the price crashes and it leaves the normal retail investors who are just trying to get into something new and make some money. It leaves them now with a near worthless cryptocurrency and they lose all their money, right? So that's the fear. The fear here is that private equity is about to do the same thing. Theoretically, could be coming into the 401ks, selling you bad assets that are overinflated right before they end up crashing so that they can get out, right, and save their losses here. So that's the danger. That's the concern. Just general advice: stay informed, do as much research as you can before you move your retirement accounts into new investments, whether that's going to be private equity funds, cryptocurrency, or your nephew's taco stand. I just hope and pray that you all stay safe out there in the investment world. I've gone over 30 minutes, but thank you so much for those in the comments having a discussion about this right now. And I'd love to see people's comments below on what you think about private equity and the potential for, is this executive order going to be a good thing? Is it going to be detrimental to 401ks? Thanks for tuning in. We'll see you again tomorrow for another afternoon stream. God bless.